Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is June 9th of 2022, and we're certainly glad that everyone could join us this week. It's been another choppy week in the market. S&P 500 down about 2% or so for the week as of the end of day Thursday. Now, tomorrow's going to be a big day with that inflation data coming out. So we're going to put a roadmap together for everyone who's watching the video this week. And then also some of the divergences that we're starting to see take place underneath the surface of the market, which gets us to what we're calling this week's update, which is what's priced into stocks. We know the investor sentiment right now is awful. We know that investor positioning across the board is downright bearish with multi-year cash levels at a high. And so what we want to understand is how much of the bad data is priced in and what areas of the market are further along in this bear market process than others. Because the S&P 500 is not this uniform behemoth. It's a conglomeration of different styles of stocks and different companies and different sectors. And so certain areas tend to bottom before others. And is that beginning to happen? So we're going to review some of the short-term trading conditions going into that very important inflation report tomorrow. Number two, we're going to understand how did the NASDAQ behave during prior downturns, because we are geared toward growth stocks in our growth strategy. And then number three, what are the areas right now that are trying to work during this rough market? And can we benefit from that? So what are some of the events to watch out for? Consumer Price Index tomorrow, that's on Friday. By the time you're watching this, that data probably would have already come out. We also want to understand, how is the market going to behave on the data? Does it go up on good data, up on bad data, or vice versa to the downside? We want to keep an eye out for that. Understand that behavior a little bit. Number two, Producer Price Index. Producer Price Index is the inflation that companies see when they're dealing with their supply chain providers. The inflation report that we get tomorrow is the inflation that you and I see when we go to the gas pump, when we go to the grocery store, when we go to McDonald's. Maybe you don't go to McDonald's. I love McDonald's. But, depending on where you shop, that's the type of inflation that's coming out tomorrow. Next week's your supply chain inflation. And then, of course, on Wednesday, we get retail sales. Plus, it should be in here, is the FOMC meeting, right? That's when the Federal Reserve is going to decide on what to do with interest rates. Largely speaking, we're expecting 50 basis points next week. We're expecting another 50 basis points in July. That's largely priced into the market. No surprise there. It's really about the path of inflation and what that means for interest rates in September, October, and November in the fall. That's really what's going to move the market one way or the other. Now, the chart of the week here, surging inventory. So the one thing where we are starting to see some disinflationary forces is in retail. Target, Walmart, Five Below, we look at the dollar stores, we look at retail just in general, surging business inventories. When you do get that, you get that report that we saw this week from Target, which saying they're going to start those clearance sales, they're going to start cutting prices. That, largely speaking, is good for the consumer. That's good as we were thinking of a path to get those inflation levels back down. Where we need to do a little bit more work are on some of those rent price increases. We know that rents are going up across the nation. That's a big component of CPI. So we want to see that starting to come in. Fortunately, as we'll look further off into this report, housing is starting to show some signs of weakening as well. But believe it or not, it's good for stocks. We want all these price pressures to start easing back a little bit. But of course, oil is the one area that hasn't so far. Now, in terms of the technicals, we continue to chop around in this, what we call the chop box here, right? So anywhere between 4,000 and 4,200 on the S&P 500, that's been the price level back and forth for the last 2 weeks here. Now, we've been probing those 4,000 levels in today's trading action as people are downright squaring away risk ahead of tomorrow's inflation report. So not a whole lot of risk taking ahead of that report. Let's see what happens tomorrow. Now, underneath the surface of the hood, what are we looking for? We want to see potential summer direction. If we can get a breakout above this and through some of the 1,500-day moving averages, that portends a more healthy and more calm summer. Now, obviously, if we go underneath this consolidation, we could very well retest those May lows. The key is going to be, what is the leadership under the hood? The S&P 500 could very well go back to the lows in May, but we could start to see some divergences take place, which tends to happen during the latter stages of a bear market. And we're going to go through that in a lot more detail. Within volatility, as everyone knows, we pay attention to what's called the VIX, which is how much more am I paying for portfolio protection in the form of put options versus the equivalent of a call option, which is betting on things going up in price, more your speculative behavior. So when the VIX goes up, there's a huge demand for put options, and we see that in pricing. But we're paying attention this week is the volatility of volatility. So how volatile is volatility? This is tended to be a leading indicator for regime shifts, right? Are we shifting into a regime of higher volatility, higher daily volatility, or are we shifting into a regime of lower volatility? Lower volatility has a tendency to be good for stock prices. Higher volatility tends to be bad for stock prices. So we see here in March of 2020, we got a big rip higher. And yes, the market rallied for about a year, but we were in this high volatility regime. We've started to break down underneath that. This could be a false flag where we return right back into this trend box. But if it is something that's sustainable, that could be good for stock prices as we go into the back half of this year. Now, we have to remember that not all stocks are the same. Sometimes the S&P 500 is going to go down over 1% like it did on, or almost 1 or 2% like it did on Wednesday of this week, while growth stocks or value stocks go up 1 or 2%. Sometimes you get that style differentiation. But what we want to show here is that in 1999 to 2000, the 2003 bear market, certain areas of the market bottomed before ultimately the S&P 500 did. Same thing happened in 2008. So we see here in the tech wreck of 2000, the S&P 500 ultimately bottomed around March 12th of 2003. But notice with the NASDAQ, which was at the center of the storm, by the way, it bottomed around September 5th of 2002. So in other words, if you bought the NASDAQ on March 5th of 2002, you basically got the bottom and were making money for about 6 months by the time the S&P 500 ultimately bottomed on March 12th of 2003. If you had waited till March 12th of 2003 or beyond that, you basically left 7 to 8 months of rally on the table as it related to the NASDAQ. Same thing happened during the global financial crisis in 2008. Stocks ultimately bottomed that famous March 6, 2009 date, right? When we hit 666 intraday, never forget that. But really, the NASDAQ bottomed on November 8th of 2008. So in other words, almost 5 months ahead of, or 4.5 months ahead of when the S&P 500 did. And that ultimately proved to be leadership. Something else happened in 2008. China bottomed in 2008, stimulated by ultimately the trillions that China threw at infrastructure. So China bottomed, NASDAQ bottomed in the fall of 2008, late fall of 2008. The ultimate market bottomed in March of 2009. There is money to be made while the market is still finding a low, is the message here. And there's certain areas right now that are acting a little bit better. So when we think of the center of the hurricane, right, that really started in February of 2021. That's your growth, your IPO, your SPACs, your ARK universe of stocks, your innovation stocks, in other words. We see here these stocks, so this is the IPO index here, it started to bottom in early May and has made higher highs and higher lows ever since. Same thing happened with your ARK universe of innovation stocks. Higher lows, higher highs. I think that's really, really important here, because while the market's trying to probe underneath some of these lows that we've made in May, some of these other stocks are breaking out, and China included. So China ultimately made both a relative strength low and an absolute price low in March. Since then, it's been making a dramatic series of higher highs and higher lows. We had a good check back today after a ripping 2 weeks in Chinese stocks, but this seems like a real multi-month breakout. Now we'll have to continue to monitor that, but remember, China's been one of the most hated markets out there in terms of investor positioning. No one's wanted to touch China. You've had regulatory pressure against their tech giants. You've had political pressures and rivalry between China and the US, and it's only gotten worse with the war in the Ukraine as China sided with Russia. You've had the post-COVID lockdowns. And guess what? These stocks are going in the other direction. That's called climbing a wall of worry. That's something we always look out for. Now, as it relates to housing, we can see the anecdotal stories in Bloomberg or in the Wall Street Journal. More and more home builders are beginning to cut prices, get their inventory off their books. They've gone from being able to sell their inventory in a matter of hours or days to taking over a month. And we're seeing that whether that's in Austin, Tampa, LA. In LA specifically, you're seeing more and more cancellations as the payment shock from higher mortgage rates kicks in. And look what's happened with lumber prices. Lumber prices are down 61% since March. That's a huge drop. And we're seeing price drops in copper. We're seeing price drops in corn and in wheat and in other commodities as well. Really, the only thing that hasn't really fallen is oil and natural gas. They're kind of like the last commodities that are standing right now. And so we think eventually at some point, oil will enter a correction as well. We could be wrong on that. But when every other commodity is starting to break down, we think there's a lot of healthy disinflationary forces out there that should help the Federal Reserve and what it's trying to do here over the next few months. So what's the bottom line? There's a lot of doom and gloom out there, whether we're looking at positioning data, sentiment data, et cetera, a lot of doom and gloom. But there are areas of the market that are starting to climb that wall of worry. Number one are growth stocks. Growth stocks have made those initial lows in early to mid-May. They've been making those higher highs and higher lows ever since. There's still a lot of work to be done. We want to see if that continues. Only time will tell. Number three, the other area of the market are Chinese stocks. They are further along in the recovery process, making those March lows, higher highs and higher lows since then. In the meantime, U.S. stocks are chopping around that box, as we call it. And so we want to see a clear breakout. Whether it's good data or bad data, it doesn't matter to us. If you're looking at the technicals, all that matters is the price action. So we want to see them break out of that recent range. So that's what we got for you this week. If you have any questions or concerns, please reach out to your advisor. Give us a call at 888-543-3776. If we don't speak to you before the weekend, have a great weekend and enjoy the weather out there. And we'll see you again next week. Thank you again.